Hi, my name's Ben and I'm a Senior Commercial Manager at Piclo. I'm here today in our central London offices to talk to you about a valuable opportunity for energy asset owners, capacity market secondary trading, and why it matters for you. In this video, we're going to cover three things: a brief overview of the capacity market, what we mean by secondary trading, and how Piclo can help. First of all, let's take a moment to recap. What are capacity markets? Capacity markets are common throughout the world, but Great Britain was one of the first countries to introduce one. We're going to be talking about this market in particular today. Our capacity market essentially serves as an insurance policy against Great Britain's electricity supply. In the event that the demand for energy is forecast to exceed the available generation, the capacity market kicks in. This means that if called upon, energy assets will increase their generation or reduce their demand to avoid a blackout from happening. The companies who manage those assets are essentially paid to be on standby and provide those emergency services if called upon. These payments play a large part in financing new and existing energy projects, especially recently as we've seen capacity market prices reach record highs. Companies are awarded these contracts from the capacity market auctions, which are held twice yearly. The main auction is the T-4, held 4 years in advance of the delivery year. This is then topped up by the T-1, held 1 year in advance. Okay, now we've familiarized ourselves, let's move on to secondary trading. So first question, what is it? Secondary trading is when a capacity market contract holder transfers their obligations to another company. As they've taken on the responsibility of the contract, they also receive the payments. Here's a few things to note about secondary trading. It's subject to the normal capacity market rules. You can secondary trade a contract for a minimum of 1 day up to a maximum of the full delivery year. The minimum capacity that can be transferred is 1 megawatts. That's after the derating factor has been applied. And finally, the trade is technology agnostic. Remember we spoke about the T-4 and T-1 auctions? You can think of secondary trading as the unofficial T-4 month or T-2 month markets used by companies to top up their capacity before the delivery year is due to start in October. Because of this, the busiest trading period is usually between July and September. But why would someone want to transfer their contracts? Why trade away such a critical, guaranteed source of income? From the transferer's perspective, these contracts can be obtained up to 15 years in advance, so naturally, a lot can change by the time the delivery year comes around. For example, their asset might be offline for maintenance for all or part of the delivery year. Their new build project may be running behind schedule, or they may have been unable to adequately perform certain tests in time. These are just a select few reasons. There are many others. In the majority of cases, the contract holder will have to pay a termination fee or penalties if they don't fulfill their obligation. So really it makes sense to transfer all or part of that agreement to another company who can fulfill it. Okay, so that makes sense, but who is taking on these contracts? If all the same rules as the primary auction apply, then why get a contract second-hand and not just apply to the primary auction? From the transferee's perspective, it's often a case of timing, and sometimes it can even prove more lucrative. Here's a few examples. They may have entered into the primary auction, but weren't awarded a contract, or their new build asset may not have met key milestones in time to be qualified for the primary auction, or they could have onboarded new assets into their portfolio after the T-1 auction closed. An extra added benefit is that the payments are adjusted for inflation, further increasing their value. Now we understand a bit more about why parties might want to secondary trade. The last piece of the puzzle is, how do they find each other? As you might expect, this often comes down to traditional methods of outreach. Companies send lots of emails and call around their phone book to spread the word in the hope that they'll get some interest. This is time-consuming, resource-heavy, and is naturally limited to their circle of contacts. We heard that companies wanted greater visibility of both the demand and the supply, and that they found it really difficult to manage so many different stakeholders at various different stages of the process. To simplify all of this, Piclo has developed the first and only online marketplace for secondary trading of capacity market contracts. Transferers can now list their contracts in one single place, visible to a huge network of capacity market participants who can bid for those contracts and complete the commercial arrangement of the transfer, all via Piclo.
We've actually traded some agreements on Piclo, and that's been really great. That includes us potentially selling and buying agreements there to service our customers. But what Piclo really bring to it is an ease, really, and it's an easy way of advertising what's available.
On top of this, we have a dedicated sales and marketing team to help you find the perfect match through outreach to our extensive database of energy asset owners, the largest of its kind in the UK. As the foremost experts in secondary trading matchmaking, we offer ongoing support throughout the sourcing, bidding, and contracting process. Once the marketplace has worked its magic and a bid is accepted, parties can use our free contract template, further reducing administrative burdens and legal fees. To date, we've successfully facilitated multiple trades through our platform. If you have any questions about capacity market secondary trading or are keen to get involved, drop a comment below or email our dedicated team at exchange@piclo.energy. We look forward to helping you find your next trade. Thanks for watching.